$5,589.38. That is the highest price gold has ever traded at in all of recorded human history, a record set on January 28, 2026. And right now, as you're watching this video, gold is trading around $5,158 per ounce. So here's the question nobody on financial television is asking. If gold just hit an all-time high 5 weeks ago, why are we $431 below that peak right now? And more importantly, is this the calm before the next explosion higher, or is the rally over? I need you to stay with me for the next 20 minutes, because by the time we're done, you're going to understand exactly what's happening behind the scenes that the mainstream financial press is completely missing. There is a buyer in this market so large, so methodical, and so secretive that even Goldman Sachs had to reverse engineer their purchases from customs data. And that buyer isn't slowing down. In fact, the data suggests they're accelerating. The story of gold right now is not really about inflation, tariffs, or interest rates, although all of those matter. The real story is about a country that has made a geopolitical decision so consequential it makes every other factor look like background noise. Let's talk about China. But first, let's make sure we're all looking at the same picture. This isn't speculation, this isn't a conspiracy theory. Every single number I'm about to give you is sourced from official filings, World Gold Council reports, Goldman Sachs research, and IMF data. You can verify all of this yourself. Here's the price timeline so you understand the battlefield. Gold started 2025 trading at approximately $2,624 per ounce. By April 2025, it had pushed past $3,200. By October 8, 2025, it shattered the $4,000 barrier for the very first time in history. Then it went quiet for a few weeks, lulling people to sleep, before launching into one of the most violent upside moves in precious metals history. In January 2026 alone, gold set 11 separate all-time highs, according to the World Gold Council's data. 11. In a single month. And then on January 28, 2026, it printed $5,589.38 on the screen. That was the peak. And then something very interesting happened. Within 4 days, on February 2, 2026, gold had plunged to $4,724 per ounce, a $865 drop in less than a week. Silver fell 28% in a single day, its worst session since March 1980. The financial press panicked. CNBC ran segments asking if the gold bull market was over. And here's the thing, I've seen this movie before, not just once, 3 times. And every single time, the people who sold into that panic handed the next leg of the rally to the people who stayed calm and looked at the actual data. Let me explain what actually caused that crash, because it wasn't some fundamental change in the gold story. According to reporting from CNBC and market analysis from Interactive Brokers, the crash was triggered by one specific event: President Trump's announcement that he was nominating Kevin Warsh to succeed Jerome Powell as Federal Reserve Chair when Powell's term ends in May 2026. Why does a Fed chair announcement crash gold by $865 in 4 days? Because Warsh is known as a monetary hawk, someone who favors higher interest rates and tighter money. Markets immediately repriced. The dollar index jumped 0.8%. Traders who had crowded into leveraged gold positions had their stop losses triggered. CME Group, the exchange operator, then poured gasoline on the fire by raising margin requirements on COMEX gold futures from 6% to 8%. That's a forced selling mechanism that pushed more positions out the door. This is what CMC Markets head of Asia called, and I'm paraphrasing directly, a classic air pocket after an extraordinary run. Profit-taking by leveraged speculators collided with a policy shock, and the paper market threw up. But here's what you need to understand about the difference between the paper market and what's actually happening in the physical world, because those are 2 completely different stories right now. Quick message for those who aren't subscribed yet. My analytics show about 3 out of 4 people watching aren't subscribed. If this kind of research, where I'm actually pulling World Gold Council reports and Goldman Sachs filings and not just reading headlines at you, if that's cutting through the noise for you, hit subscribe. It genuinely helps me know who the serious community is, and it helps the algorithm put this in front of more people who need to see it. Now, back to China. And this is where it gets genuinely jaw-dropping. The People's Bank of China, the PBoC, officially reported in January 2026 its 15th consecutive monthly gold purchase, 15 months in a row. not missing a single month, even as prices were hitting all-time highs. They added 1.2 tons in January alone, bringing their officially reported total to 2,308 tons, representing 9.6% of China's total reserve assets, according to the World Gold Council's February 2026 report. That 9.6% figure matters enormously because it's up from just 5.5% in December 2024. In 14 months, China went from 5.5% gold allocation in their reserves to 9.6%. If you're running the second largest economy on Earth and you're moving that fast, you are not dabbling. You are executing a strategic plan. But here's where it gets truly alarming. And this is documented, published research that Goldman Sachs, Bloomberg, The Washington Post, Time Magazine, and the Financial Times have all confirmed and written about. The official numbers are the tip of the iceberg. According to researcher Jan Nieuwenhuis at Money Metals, whose methodology Goldman Sachs has since independently replicated, China is buying roughly 5 to 11 times more gold than it officially discloses to the IMF. Let me say that again, 5 to 11 times more. Goldman Sachs estimates that in November 2025, China's actual purchases were approximately 10 tons, while the PBoC officially reported just 0.9 tons. That's 11 times the disclosed amount. In September 2025, Goldman's estimates put actual Chinese purchases at around 15 tons, roughly 10 times what was officially reported. The methodology behind these estimates isn't guesswork. It compares World Gold Council quarterly field research, which accounts for all known physical supply and demand flows, against the official IMF figures that China self-reports. The gap between those two numbers is enormous, and it began widening dramatically in 2022. You can probably guess what happened in 2022. Russia invaded Ukraine. The United States and its allies froze approximately $300 billion in Russian central bank reserves overnight. China's leadership watched that happen and made a decision that is now reshaping the entire global financial system. Let me give you the full picture on China's estimated true reserves, because this number should stop you in your tracks. The officially reported figure from Beijing is 2,308 tons. But Nieuwenhuis's estimates, using customs data, SGE vault flow analysis, and London to China bullion shipment tracking, put China's real monetary gold reserves at approximately 5,411 tons as of the third quarter of 2025. 5,411 tons. To put that in context, the United States officially holds 8,133 tons, making it the world's largest gold holder. Germany is at 3,350 tons. If these estimates are correct, and multiple independent researchers and Goldman Sachs are now using variations of this methodology, China isn't fifth in the world in gold reserves. They may be rapidly approaching second place, with most of that metal sitting completely off the official books. The evidence for the covert purchases isn't just inference from supply-demand math. There's direct physical evidence. Gold shipped directly from the London bullion market, where bars are traded in 400-ounce formats, directly to China. Here's why that's significant. On the Shanghai Gold Exchange, the private sector only trades in 1 kilogram bars. So if large format London bars are going directly to China without passing through SGE refinement channels, the only plausible recipient is the central bank. The SGE itself, according to sources cited by Nieuwenhuis, has confirmed that the observed surplus in China's gold market isn't accumulating in their vaults. It's going somewhere else. That somewhere else is the PBoC's vaults. Now let's zoom out and look at the macro picture that makes all of this make sense. Because China isn't doing this randomly. They're not buying gold because they like shiny things. They're executing a decades-long strategy to escape a vulnerability they've identified as existential. Here's the historical pattern, and I want you to notice how perfectly it rhymes with what's happening today. In the 1940s, the United States emerged from World War II as the world's dominant economic and military power. At the 1944 Bretton Woods Conference, the dollar was explicitly tied to gold at $35 per ounce, and every other currency was tied to the dollar. The world ran on American money. That gave the United States extraordinary power. Economists call it the exorbitant privilege. You get to run deficits, export inflation, and basically write the rules of global finance because everyone needs your currency. The British pound had a similar dominance before that. In the 19th century, Britain's pound sterling was the global reserve currency, backed by British industrial supremacy and the world's most powerful navy. But as British economic power relative to the United States grew weaker after World War I, the pound slowly lost its reserve status. Countries that held pounds as reserves started quietly diversifying. Britain tried to defend the peg. They ran deficits to maintain the fiction, and eventually, the market forced a reality check that no amount of political will could stop. The parallel to America's dollar today is not exact, but the mechanisms are disturbingly similar. America's national debt has now crossed $36 trillion. The annual interest payments on that debt have exceeded $1 trillion for the first time in history. The federal deficit runs at approximately 6 to 7% of GDP in what is technically a peacetime economy. And since 2022, the United States demonstrated to every central bank on Earth that dollar-denominated reserves can be frozen at will as a geopolitical weapon. You don't have to be anti-American to understand why a country like China, which has its own festering territorial disputes with neighbors who are U.S. treaty allies, would look at what happened to Russia and start moving their reserves into something that cannot be frozen, confiscated, or weaponized. Something physical. Something that's been money for 5,000 years. Gold. Stick with me here because this next part is critical, and it's where the current gold rally connects directly to something much bigger than just a price chart. In November 2025, a landmark event took place that got almost zero coverage in the Western financial press. On November 19, 2025, the chairman of the Central Bank of the United Arab Emirates completed a live digital currency transaction with the governor of the People's Bank of China, formally inaugurating what's called Project M-Bridge. What is M-Bridge? It's a multi-currency cross-border payment platform that allows participating countries to conduct bilateral trade in their own local currencies, completely bypassing the US dollar. Saudi Arabia is part of this project. The UAE is part of this project. Other emerging market economies are signing on, and China, as the world's largest trading partner for most of the globe, is at the center of it. Now here's the piece that connects directly to gold. For M-Bridge to work as a true alternative to the dollar system, there needs to be a way to settle trade imbalances. If China buys more from Saudi Arabia than Saudi Arabia buys from China, Saudi Arabia ends up holding excess renminbi. What do they do with it? Under the dollar system, they'd buy U.S. treasuries. Under M-Bridge, the design calls for those surplus currencies to be exchangeable into gold. That means China doesn't just need gold as a reserve asset. China needs gold as the settlement mechanism for a new parallel financial system they are actively building. That changes the demand picture for gold in a way that has no historical precedent in the modern era. Let me pile on the evidence now because there's a lot of it and each piece reinforces the same conclusion. Global gold ETF holdings reached an all-time high in January 2026 at 4,171 tons, according to the World Gold Council's February 2026 report. They then added another 26 tons in February despite the price pullback. Total assets under management in gold-backed funds hit $701 billion, another record. North American ETF inflows were positive for the 9th consecutive month as of February 2026. The World Gold Council noted that outside the initial conditions phase, there have only been 2 other periods in which North American gold funds recorded 9 straight months of inflows: during the global financial crisis of 2008 and during the COVID-19 pandemic. Both of those periods were characterized by elevated systemic risk. That's not a coincidence. That's a signal. Chinese gold ETFs had their strongest January on record in 2026, adding 38 tons worth, approximately $6.2 billion in a single month, according to the World Gold Council. Total Chinese gold ETF assets under management hit an all-time high of 333 billion yuan. And this is happening while Chinese retail jewelry demand has actually slowed because prices are too high for casual buyers. The people flowing into Chinese gold ETFs right now are not grandmothers buying gold bracelets. They're institutional investors who are making a calculated allocation decision. Now let me show you the smoking gun, the disconnect between what the paper market is telling you and what the physical market is actually doing. When gold crashed from $5,589 to $4,724 in early February 2026, the standard financial media narrative was, "Gold bull market over, rally exhausted, time to sell." But look at what happened in the physical market simultaneously. According to market data published by USA Gold on February 2, 2026, physical premiums on American Eagle gold coins remained elevated at 9 to 11% over spot price during the sell-off. Let me translate that. Even as the paper price on COMEX was crashing, dealers were still charging significant premiums above that price for actual physical metal. Why? Because the people who buy physical gold weren't selling. They were buying the dip. Gold-backed ETFs continued adding metal throughout the correction. The PBoC kept buying. Central banks kept buying. The paper traders got shaken out. The physical holders didn't move. JP Morgan's analysts, in a research note, characterized this dynamic precisely. They noted that gold's thematic drivers remain positive and that quarterly investor and central bank demand is expected to average around 585 tons, well above the 350 tons needed to keep prices moving upward. Goldman Sachs raised their December 2026 gold price forecast to $5,400 per ounce. Wells Fargo has an even more bullish target of $6,100 to $6,300. And here's what makes these institutional forecasts credible rather than promotional. They're all anchoring their models to the same structural variable, central bank demand, specifically China. Let me ask you something. If China is, according to Goldman Sachs estimates, buying 10 to 15 tons of gold per month in reality versus the 0.9 to 1.2 tons they officially disclose, and if this has been happening continuously since at least 2022, what is the actual total China has accumulated that nobody knows about? Neuenhaus's estimate puts it at 5,411 tons. The US has 8,133 tons, the most in the world. If China is at 5,411 tons and buying at this pace, they could surpass every country on Earth except the United States within a few years. And this is the scenario that keeps certain people in Washington up at night, if China ever publicly revealed its true gold holdings and simultaneously moved to partially back the renminbi with gold, even informally, the impact on dollar confidence would be staggering. This isn't conjecture. The mechanics of how this could work are already being built through Enbridge. Neuenhaus wrote in December 2025, and I want to paraphrase this carefully because it's important. China aims to establish an alternative to the US dollar, not by issuing their own global reserve currency, but by making gold the neutral settlement layer underneath a multi-currency trading system. That's elegant because it means China avoids the risks of issuing a reserve currency, which would expose them to the same vulnerabilities America has, while still undermining dollar dominance. Gold does the heavy lifting. It's no one's liability. It can't be sanctioned. And they've been quietly stacking it for years while the world watched stock tickers. Now I want to show you the math that proves this can't be random market behavior. Global central bank gold purchases exceeded 1,000 tons per year for 2022, 2023, 2024, and 2025, 4 consecutive years, a pace not seen since the 1960s, according to Mint Builder's analysis citing World Gold Council data. Before 2022, the pre-war average was 400 to 500 tons per year. So we went from 400 to 500 tons annually to over 1,000 tons annually the moment the Russian reserve freeze happened. Goldman Sachs estimates that central banks are now purchasing approximately 60 tons of gold per month, which is more than 3 times the pre-2022 average of 17 tons per month. JP Morgan projects 755 tons of global central bank purchases in 2026 alone. Gold's share of global international reserves rose from 21% in 2024 to nearly 28% by Q3 2025, according to Neuenhaus's research. In a single year, gold went from just over 1/5 to more than 1/4 of all international reserves. That is a seismic structural shift in how the world's central banks think about money. And non-Western countries now hold 49% of all central bank gold, up from just 25% in the 1990s. The world is quietly, systematically, rebalancing away from paper claims on Western governments and toward physical metal. That is not random. That is coordinated. And when you understand that, the gold price chart stops looking like speculation and starts looking like a map. Okay, so let's bring this home and make it personal, because here's what I actually think you need to know about what's happening right now, in March 2026, with gold sitting at roughly $5,158. That's $431 below the all-time high. First, the correction from $5,589 to the mid-4,000s in early February was a positioning reset, not a trend reversal. Deutsche Bank said specifically, and I'm paraphrasing, that gold's thematic drivers remain positive and investors' rationale for gold allocations has not changed. The people who sold into the panic sold to the people who were waiting to buy at a discount. ETFs added 26 tons in February despite the lower prices. The PBoC added 1.2 tons in January and has not stopped buying. The The structural demand floor has not moved. Second, the current price around $5,158 represents a roughly 8% discount to the all-time high. In the context of a bull market that has run 116% in 13 months, from $2,390 in early 2025 to the $5,589 January high, an 8% pullback is noise, healthy even. Markets need to breathe, but breathing is not dying. Third, and this is the practical thing I want you to think about, the Enbridge platform is live as of November 2025. This isn't a future development, it is operational. Countries are conducting real transactions on it right now. The infrastructure for a parallel dollar bypass financial system exists and is being used. Every month that Enbridge settles more volume is a month that more gold gets pulled into that system as the settlement anchor. This is a demand driver that wasn't in any gold price model 2 years ago, and it's real. Fourth, pay attention to the Federal Reserve chair situation. Kevin Warsh has been nominated. If confirmed, markets expect a more hawkish Fed. A hawkish Fed could temporarily strengthen the dollar and weigh on gold in the short term. But, and this is crucial, even in the hawkish scenario, the structural demand from China and other central banks is price insensitive. The PBoC kept buying gold through every stage of the 2025 rally. They bought at $3,000, they bought at $4,000, they bought at $5,000. Higher interest rates in the U.S. are unlikely to make Beijing change its geopolitical reserve strategy. Fifth, watch the Shanghai Gold Exchange withdrawal data. Monthly withdrawals from the SGE are the best real-time proxy for wholesale Chinese gold demand. When withdrawals surge, physical demand is absorbing supply. When they slow, the market is digesting. January 2026 SGE withdrawals were 126 tons, essentially flat with January 2025, but 11 tons above December. That's solid. That's not a market breaking down. Sixth, watch for the February PBoC reserve report, which should be published in early March. If the PBoC reports its 16th consecutive monthly purchase, even a small one, that is a signal. Not because 1 or 2 tons moves the market directly, but because the public announcement signals continued intent. And as the World Gold Council noted, PBoC announcements have encouraged Chinese retail investors to buy gold, creating a multiplier effect. Seventh, the Wells Fargo target of $6,100 to $6,300 and Goldman's target of $5,400 by December 2026 give you a rough range for where institutional money is positioned. If those models are right, we're currently sitting at a level that is well below even the conservative end of institutional 12-month targets. I'm not telling you what to do with that information, but I want you to have it. And of course, none of this is financial advice. I'm a researcher, not your broker. Do your own due diligence, consult a qualified financial advisor, understand your own risk tolerance, and make your own decisions. What I'm doing here is giving you the information so those decisions can be informed. Let me bring this full circle because I opened with a number and I want to close with what that number means. $5,589.38. Set on January 28, 2026. 6 weeks later, gold is at $5,158, $430 below that record. And the mainstream financial narrative right now is uncertainty, volatility. Maybe the rally is over. Maybe rates go higher. Maybe the dollar comes back. But here's what that narrative is missing. The People's Bank of China has now bought gold every single month for 15 consecutive months. Goldman Sachs estimates the real monthly volume is 10 to 15 times what China officially discloses. Their estimated actual reserves are 5,411 tons, a number so large it would make China the second largest gold holder on Earth if revealed. They have launched a live cross-border payment platform designed to bypass the dollar. They are building the infrastructure to use gold as the settlement layer for a new parallel monetary system, and they are not stopping. The historical pattern here is unmistakable. Every time a reserve currency empire has declined, the transition was visible in the gold market before it was visible in currency markets. Gold didn't crash the British pound. The pound crashed, and gold recorded it. Gold didn't break the Bretton Woods system. Bretton Woods broke, and gold shot from $35 to $850 in a decade. The signal always comes in the metal first, because gold can't be printed, it can't be frozen, and it doesn't lie. The people who held gold in 1970, right before Nixon closed the gold window, who were told they were paranoid and that the dollar was fine and that inflation was under control, those people watched gold go from $35 to $850 over the following decade. A 2,300% gain. The signs were there. The deficit spending was there. The currency pressure was there. Most people didn't see it because they were told not to look. The signs are there now. Whether you act on them or not is entirely your decision. But you've seen the data. The numbers are real. The institutions buying this metal are real. The geopolitical shift underway is real. The only question is whether you're paying attention before the next move happens or after. Drop a comment and tell me this. Do you think gold breaks the $5,589 all-time high again before the end of 2026? Yes or no? And what's your reasoning? I genuinely read every comment. Your thinking helps me figure out what to cover next, and honestly, some of the best insights I've gotten on this topic have come from this community. The comment section on this channel is legitimately better than most financial forums. So let me know what you think. If you haven't subscribed yet, you made it this far, that's the sign. Hit subscribe. I cover gold, silver, and macro finance with actual source data, not just vibes and headlines. New videos multiple times a week. And if you want to go deeper on the Enbridge story specifically, I have a full video on that in the feed. Link is in the description. That video explains the mechanics of what a gold-backed settlement layer actually looks like in practice and why it matters more than anything the Fed is doing right now. Thank you for watching. Stay curious, stay skeptical of the consensus, and I'll see you in the next one.